remaining videos in this series, we dig deeper into understanding the financial statements. We will see that there are 4 fundamental issues in financial reporting that will continue to pop up. The first is, what information should be disclosed? Once we know the answer to this question, we must decide where the information should be disclosed: in the financial statements themselves or in the footnotes. When we know what is included in the financial statements, we then have to decide how to attach dollar values to the financial statement accounts. And finally, we must choose where to classify the accounts on the financial statements. Let's now spend a few minutes with each of these questions, starting with the financial information that should be disclosed. The answer here is any financial information item that is relevant to the financial condition or performance of the company. Relevance means, does the information tell us something economically meaningful about the financial well-being of the company? The information must also be material or large enough to influence the decisions of financial statement users. And finally, the financial information must be objective, unbiased, and verifiable. It should not be the result of unsupported claims. Disclosing financial information that meets these important criteria, relevance, materiality, and objectivity, to a company's owners, potential investors, and others is one of management's key responsibilities. That brings us then to the second question. Where should the financial information be disclosed? Do we place the information in the financial statements themselves, or do we place the information in the footnotes used to provide the details supporting the financial statement numbers? If the information is to be placed onto the financial statements, it will appear in the accounts that comprise the balance sheet, the income statement, the statement of cash flows, and/or the statement of shareholders' equity. If we choose the footnotes, the information will be combined with lots of other specific detail about the dollar values on the financial statements. For example, the balance sheet might include this kind of disclosure for property, plant, and equipment, including the original cost, $10,000, less accumulated depreciation, $2,000, leading to a net number, in this case, $8,000, with very little additional information included in the footnotes. Or, on the other hand, the balance sheet might look like this, disclosing only the $8,000 net number, with all the additional detail contained in the footnotes. Either form of disclosure is acceptable, but in the latter case, the reader is forced to dig into the footnotes to find the information. One lesson to be learned here is that one must read the footnotes because they often contain very useful detail about the numbers on the financial statements. The third question, how to attach dollar values to the financial statement accounts, is referred to by many people as the valuation question. On the balance sheet, this question refers to the actual dollar amounts placed behind the accounts. For example, should the asset account short-term investments be valued at the original cost of the investments or their current market values? Or a second example, what method of depreciation is used to calculate accumulated depreciation in the net valuation of the property, plant, and equipment account on the balance sheet? These kinds of valuation questions also apply to the income statement, where dollar values need to be attached to each of the revenue expense accounts in the calculation of net income. For example, how should the sales revenue account be valued for the year? Is $25,000 the proper amount? Or again, what depreciation method should be used to compute the depreciation expense on the income statement? These valuation decisions are important because they determine the dollar amounts on the financial statements, which in turn provide key performance measures like net income, return on equity, return on assets, and all the measures of the various kinds of company performance we have covered up to now. As we dig deeper into the financial statements, we address valuation issues in greater detail. Let's now turn to the fourth and final question: where to classify the accounts on the financial statements, or more simply, the issue of classification, another important concept in financial reporting. It involves how the revenues and expenses are classified on the income statement. It involves how cash transactions are classified on the statement of cash flows, and it involves how assets and liabilities are classified on the balance sheet. For example, the income statement makes a very important distinction between operating and non-operating revenues and expenses. The operating revenues and expenses, which are associated with the primary and repeatable activities of the company, lead to net operating income, which is normally considered to be relatively stable, while non-operating revenues and expenses tend to be one-shot, temporary events that are unusual and many of which are not expected to repeat in the future. Similarly, the statement of cash flows is based on an important classification scheme that separates the cash effects of operating activities from the cash effects of investing activities from the cash effects of financing activities, three very different but important business processes. Finally, the balance sheet is based on a useful classification that separates current assets and liabilities from non-current assets and liabilities. To illustrate the importance of classifications like these, let's take a few minutes now to learn how the current non-current balance sheet classification plays a role in a variety of different kinds of business decisions. Let's begin our discussion with the current classification by defining current assets and current liabilities. On a typical balance sheet, current assets would include cash, short-term investments, accounts receivable, inventories, and prepaid expenses, while current liabilities would include a variety of short-term payables, current maturities of long-term debt, and unearned revenue. The formal definition of current assets includes assets expected to be converted into cash or expired, as in the case of prepaid expenses, within the company's current operating cycle or 1 year, whichever is longer. What is the current operating cycle? The current operating cycle is the time period it takes from cash to the creation of a product or service that is then delivered or completed for a customer or client, often creating an accounts receivable, which in turn is collected by the company and returned to cash. Operating cycles can vary enormously across different companies. For example, it may take Boeing, the aircraft manufacturer, years to build aircraft ordered by Delta, and Delta's payments to Boeing may extend over many years. This would lead to an operating cycle of perhaps 3 to 5 years. Typical grocery store chains, on the other hand, like Safeway or Kroger, might have operating cycles no longer than weeks or perhaps even days. This would mean then that a note receivable due in 2 years would be considered a current asset on Boeing's balance sheet, because for Boeing, current is defined by its 3 to 5 year operating cycle, and the 2-year note will be collected within the 3 to 5 year current period. While the same 2-year note receivable on Safeway's balance sheet would be considered long-term or non-current, because for Safeway, current is defined by 1 year, and the note is expected to be collected after that time period. The definition of current liabilities is much simpler because they are defined as any liability or obligation expected to require the use of assets listed on the balance sheet as current. You see then that these two definitions are linked together. This is done because current assets and current liabilities, both of which involve operating activities, are linked together in popular metrics like working capital, current assets less current liabilities, and the current ratio, current assets divided by current liabilities. Both of these metrics are commonly used by investors and creditors to assess a company's solvency position, its ability to meet its debts as they come due. To gain a sense of how important current assets are on the balance sheet of companies across different industries, here are some stats of current assets to total assets for a selection of well-known companies. In manufacturing, while both Ford and Bristol-Myers Squibb carry huge inventories, Ford's current asset percent is larger because it also carries huge receivables. It owns its own financial institution, which provides much of its customer financing. In retail, Nordstrom carries higher current assets than Walgreens because, unlike Walgreens, it offers its own credit card. So again, its receivables are relatively high. In the internet sector, neither Cisco nor Facebook carry any inventory, but both have large cash balances and short-term investments. Cisco's percent is higher, however, because it too carries very large receivables, much more so than Facebook. In the service industry, again where no inventories are carried, FedEx's primary current asset is receivables, and current asset on AT&T's balance sheet are swamped by its gigantic investment in non-current assets. This kind of analysis is interesting because one can learn about the nature of a company's activity and the major issues it faces by looking at these kinds of financial ratios.